Hello and welcome. Today we're going to talk about a really common investing problem. How do you get that sweet, sweet growth without losing sleep every time the market has a bad day? Well, the answer might just be something called a hybrid fund. By the end of this, you'll know exactly what they are and, more importantly, if they're the right choice for you.
You know, every investor, especially when they're starting out, faces this classic dilemma. Do you go all in on equities, stocks for that high growth potential, even though it can feel like a total roller coaster? Or do you play it safe with debt instruments like bonds, which are way more stable, but let's be honest, can be kind of slow? It really feels like you have to pick one. But what if you didn't have to?
And that's exactly the problem hybrid funds were created to solve. They just don't force you to pick a side. Instead, they bring growth and stability together, all under one roof. It's like having your cake and eating it too. So what is a hybrid fund, really? At its core, it's just a mutual fund that invests in a pre-made mix of both stocks and bonds. Think of it like a trail mix. You get the sugary, high-energy M&Ms from the stocks, and you get the steady, reliable nuts and raisins from the bonds, all in one handy bag. It's a blended portfolio right from the get-go.
Here's a great way to think about how they work. The equity part of the fund, that's your engine. It's all about speed, acceleration, and growth potential. The debt part, on the other hand, is the suspension system. It's the shock absorber that smooths out all those bumps in the road, giving you stability when the market gets rocky.
Now, you might be wondering, and it's a fair question, why don't I just buy some stock funds and some bond funds separately? Why do I need someone to pre-mix it for me? And the answer really boils down to two things: convenience and professional management. See, this is the key advantage. It's a ready-made deal. A professional fund manager is handling the mix for you. They decide how much to put in stocks versus bonds. And this is the important part, they rebalance it for you. That means you don't have to constantly check in and sell one to buy the other to keep your mix right. It's like having automated expertise. And this quote just nails it. It's the perfect way to think about it. It's an all-in-one portfolio designed to give you a balanced approach right out of the box. Simple as that. But hey, ready-made does not mean one size fits all. Not at all. Hybrid funds actually come in a few different flavors, and each one has a unique mix that's tailored to different appetites for risk. So let's break down the main types. First up, you have conservative hybrid funds. The name kind of gives it away, right? These are all about safety. We're talking about 75%, sometimes more, of the money being invested in stable debt. Only a little slices in stocks. So the main goal here is protecting your money while still trying to get a little bit of growth. And on the complete other end of the spectrum, you have aggressive hybrid funds. These are for people who want more growth. Here, the mix is flipped upside down, with the lion's share, about 75%, invested in stocks. The debt part is much smaller, acting more like a cushion instead of the main event. And then there's this really cool adaptable category, dynamic, or sometimes called balanced advantage funds. With these, the mix isn't set in stone. The fund manager can actively shift between stocks and bonds. So if they think the stock market is looking too expensive, they might sell some stocks and buy more bonds. If they see a great opportunity, they'll shift back. It's a much more active strategy. This little table here really helps put it all together. To find your fit, all you have to do is ask yourself, what's my main goal? If the answer is stability, please, a conservative fund is probably your best bet. If it's let's go for growth, then an aggressive fund is the way to go. And if you'd rather have an expert make those calls for you depending on the market, then a dynamic fund might be perfect. Okay, we've covered the different mixes and the risk levels. Now for the million-dollar question, right? What kind of returns can you actually expect from these things? It is so important to have realistic expectations here. Hybrid funds were literally designed to live in the middle of this risk-return spectrum. The goal is not to outperform a pure stock fund, but to give you a much smoother ride. You're basically trading some of those potential sky-high gains for less volatility, while still aiming for better returns than you'd get from just plain old debt funds. So let's try to put some rough numbers on that. For a conservative hybrid fund, a typical historical return range might fall somewhere in the neighborhood of 6 to 9%. Again, the focus is more on stability. Now, for the more growth-focused, aggressive hybrid funds, that expected range historically has been a bit higher, maybe around 9 to 12%. And that just reflects its bigger slice of the stock market pie. Okay, and I really cannot stress this enough. These numbers are just historical averages. They are not a promise, they are not a guarantee. All mutual fund returns are tied to the market, and performance can and absolutely will go up and down.
You have to understand this before you put a single dollar in. All right, so with all of this info, you can finally start to ask the real question. Is a hybrid fund a good fit for me and my portfolio? Let's take a look at who these funds are really built for.
So who is this for? Well, they're a fantastic fit if you're a beginner who's kind of nervous about jumping into the deep end of the stock market. A hybrid fund is like a life raft. It gives you a cushioned entry. They also work great for anyone who has a moderate risk tolerance, or really for anyone who just wants a simple, set it and forget it kind of investment.
And to invest smartly, you also need to know what not to do. So here are 3 big mistakes to avoid. First, manage your expectations. These are not going to give you crazy tech stock-like returns. Second, know what you actually own. An aggressive fund is a completely different animal from a conservative one. And finally, think long-term. These are not for chasing quick, short-term profits.
And at the end of the day, it all comes back to this one simple idea. With a hybrid fund, the goal isn't to hit a home run every single year. It's about getting balanced, sensible growth that builds your wealth over time, while hopefully letting you sleep a little better at night. It's all about that peace of mind.
This conversation is for educational purposes only. Mutual fund investments are subject to market risks. Please consult a qualified professional before investing.